3M is an interesting dividend stock. In fact, I had 3M rated as one of my top dividend stocks to buy in 2023, I believe it was, either 2022 or 2023. I had it rated as one of my top dividend stocks to buy. Now, it's been some time since I've covered 3M, and so in this video, I wanted to revisit this interesting dividend stock and do a discounted cash flow valuation analysis on it again and determine what I think the intrinsic value per share is, or what I feel is a fair price for 3M stock today. Let's get into it. I want to thank The Motley Fool for sponsoring this video. Visit fool.com/parkev for the 10 best stocks to buy now. So 3 of the inputs I'm going to need for my valuation model is the company's market cap, the long-term debt and cash and short-term investment balance at 73 billion, 13.2 billion, and 7.3 billion respectively. I also need the company's number of average shares outstanding at 552.7 million. You can also see this downward trend here. What this means is that the company is using its cash flow to buy back stock. So it goes out into the marketplace and uses its own money to buy back shares of its stock, and thereby it reduces the number of shares outstanding. And what that does is if the earnings stay the same, if net profits stay the same, the earnings per share increase because there's fewer shares outstanding. This is the denominator in the earnings per share calculation. And so when the denominator is decreasing, if earnings are staying the same, the earnings per share is increasing. I'm also going to utilize Wall Street analyst estimates for the company's free cash flow expectations over the next 5 years. In 2024, that number is 2.38 billion, up to 2.96 billion in 2025, 4.27 billion in 2026, down to 3.36 billion in 2027, and back up over 5 billion in 2028. So now that we have all the inputs, we can jump into our discounted cash flow model for 3M. Starting with the 2024 free cash flow of 2.38 billion, all the way up to 5.03 billion. These numbers were provided by Wall Street analyst estimates, and I incorporated them into the valuation. Between 2029 and 2034, I incorporated my own forecast, and since the company's free cash flow growth rate between 2024 and 2028 was 20%, I'm going to use 10% as the free cash flow growth rate between 2029 and 2034. And then from 2035 to infinity, I'm going to have the company growing its cash flow, forecasting it at 5%. So I have the company's growth rate slowly slowing down from 20% over the next 5 years, down to 10% over the 5 years after that, and then finally down to 5% between the years 2035 and infinity. From that point onward, instead of individually forecasting free cash flows between 2035, 2036, and all the way out to infinity, there's a shortcut formula you can use to bring together or collect all of those cash flows between 2035 and infinity. It's called the terminal value calculation or a horizon value. Depending on the textbook you're using, it'll have different terms for this shortcut. And basically what it does, it takes the free cash flow 1 year ahead divided by the weighted average cost of capital minus the growth rate. And it gives you the terminal value at this point in time in the year 2034. That terminal value is $179 billion. So far, we've forecasted a lot of cash flows in the future. What we need to do now is take all those cash flows that are expected in the future and bring them all back to today. Bring them all back in one point in time. And we call that discounting cash flows. And you discount them because money in the future is worth less than money today. So you give it a discount. And that discount rate we call the weighted average cost of capital. And that includes the cost of debt and the cost of equity. All businesses are financed by these two sources or a combination of these two sources. And the discount rate I'm using for 3M is 10.26%. I'm applying a cost of debt of 7.5%, and a cost of equity at 10.75%. The company has a beta of 1. I'm applying a risk-free rate of 4.75% and a market risk premium of 6%. Since the company's market cap is $73 billion and it has $13 billion in debt, I'm assigning a target capital structure of 15% debt and 85% equity. So when I take this discount rate and I apply it to all of these future cash flows and bring them all back to today, I get a value of its operations at $99.85 billion. That's the value of the free cash flow the company is expected to earn between today and infinity. To this total, I need to add the company's cash balance of $7.3 billion and subtract the debt of $13.2 billion. That gives me a value of equity of $93.96 billion. But I want to know the price per share, so I divide that by the number of shares outstanding of 552.7 million. And that brings me to an intrinsic value per share for 3M at $170. Now you can compare that with the current market price of $134, and I come to the conclusion that the stock is undervalued. I apply a margin of safety in these calculations of between 5 and 10% in most cases. In this case, because it's 3M, because its cash flows are more stable, because its capital structure is more stable, because the beta is lower, and there's less uncertainty with a company like 3M versus some unprofitable growth stock with relatively few years in the market with wide ranges of expected free cash flow. With 3M, those uncertainties are narrower, so I can apply a margin of safety closer to 5% instead of a margin of safety closer to 10%. Even if I was, however, to apply a margin of safety of 10%, it would still indicate the stock is undervalued. So, regardless of a 5 or 10% margin of safety, the intrinsic value per share, or what I feel like the stock is worth today, is significantly higher than the current market price of $134. So, indeed, following these inputs and these estimations, I do believe that 3M is an undervalued dividend stock right now at current prices. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.